Third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds and you're driving a 9,800-pound truck, you drive down further and find another bridge. I mean, nobody knows exactly what that capacity is, and it may have been sign may have been put up 3 years ago. So you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market.
Margin of safety. That is an important aspect of this. And as we keep going on this journey moving forward, it's important that we understand what margin of safety means. Um, and I'm gonna just give you an example, a practical example. Let's say we have Apple, and Apple is valued at $100 a share, not the share price. This is different. Let's say Apple is valued at, meaning revenue, outstanding shares. It's a whole calculation that bases what the value of a company is based on a lot of different factors, right? So we do the math, we figure it out. Okay, cool. So Apple's valued at, if it's sold today, if we sold the business, it's valued at $100 a share, right? A few years ago, Elon Musk bought Twitter. And he bought Twitter, I think, at around like $49 billion. It might have been low 50s. I can't remember. But he bought Twitter at, let's say, 50 billion. So at the time, when Twitter's share price was around $47 to $50 a share, Elon basically took the plunge and said, I want to buy Twitter. Twitter is now not a publicly traded company. It's a private company. But at the time that he bought Twitter, it was valued at around $47 to $49 billion. So let's go into Apple, for example. Let's say Apple is valued at $100 a share. A margin of safety would mean that you would not buy Apple at $100 a share. Because what Benjamin Graham and Warren Buffett is basically saying is you want to get it at a discounted price.